Walk into any upscale neighborhood and you will see plenty of people who look incredibly wealthy. They drive the latest German cars, wear luxury labels, and live in premium apartments. This high-speed lifestyle often functions as a fragile equilibrium. When every dollar of a high salary is committed to maintaining a certain image, the earner remains one missed paycheck or a minor market downturn away from absolute financial collapse. They are running as fast as they can just to maintain the appearance of success. This stems from a widespread societal error, the assumption that visible income and actual wealth are the same thing. A high salary provides no security if the earner continues to play a financial game without understanding the underlying rules. The psychological trap that neutralizes income growth is known as the hedonic treadmill, the constant escalation of lifestyle expectations. At 23, an entry-level worker might manage to survive on roommates and cheap food. But as promotions arrive, the brain automatically resets its baseline. Suddenly, a solo apartment in a trendy neighborhood and a premium car feel like basic necessities rather than luxuries. This chart shows the math of lifestyle creep. When your income increases by 50%, but your expenses also rise by 50%, your net wealth accumulation remains at zero. You are simply a higher-paid version of broke. Actual wealth is the invisible capital that remains unspent, the investments and equity generating interest while you sleep. Visible spending often converts liquid capital into depreciating liabilities to signal a status that hasn't been earned. Traditional middle-class advice suggests that the path to security involves halting spending and hoarding money in a safe, fixed savings account. Long-term wealth kept in uninvested cash functions like a melting ice cube. It appears solid, but the environment is constantly eroding its mass. If inflation sits at 6% and your bank pays 3%, you lose purchasing power every single day. The problem is compounded by tax drag. Earned income is heavily taxed, leaving you with significantly less seed money to grow your future. The wealthy treat cash strictly as a temporary strategic weapon used to acquire productive assets. To maintain value, your money must outpace the combined rate of inflation and currency devaluation. Failing to expose capital to the broader economy via equities or real estate guarantees a decline in purchasing power. Most people are conditioned to prioritize a certain fixed salary over the possibility of ownership. Society teaches us to play not to lose, rather than playing to win. This creates a psychological paradox. Many are terrified of a 20% drop in the stock market, yet they ignore the 100% certainty that their cash will lose half its value over 20 years due to inflation. This is the framework of asymmetric risk. The goal is to find opportunities where the downside is limited and known, but the potential upside is mathematically infinite. This involves investing in personal skills, buying equity in companies, and accepting short-term price fluctuations in exchange for long-term compound growth. Choosing to avoid all volatility effectively locks a person into trading their time for a fixed, heavily taxed wage for their entire career. Building actual wealth requires the cumulative impact of boring, disciplined choices made over several years. It involves choosing index funds or side businesses over credit-fueled consumption. While others upgrade their cars and vacations, the wealthy focus on building their balance sheets. Breaking the cycle requires a shift in identity. One must stop acting as a consumer of products and start acting as an owner of capital. The modern economy is fueled by mass consumption, which serves to strengthen the balance sheets of those who own the underlying assets. Your current job is the engine that funds your future. By keeping your baseline expenses steady and ignoring status games, you allow the mathematical power of compounding to build true, invisible wealth.